Welcome to the deep dive. We're here to unpack the news that really matters to your world. Today, we've got two pretty significant shifts brewing. Both could really change things up for your wallet and, for the wider U.S. markets. Yeah, our goal is simple: cut through the noise, give you the essentials. So first, we'll get into the new U.S. crypto tax rules kicking in from 2026, and then we tackle this really hot debate in Washington, the push to maybe scrap mandatory quarterly earnings reports from companies.
It's interesting, isn't it? Because both topics, they really touch on this tension. Regulation versus innovation, or maybe short-term thinking versus aiming for the long haul. These aren't just like small tweaks. They're part of bigger conversations about transparency, how information flows or doesn't flow in our economy.
That's a perfect way to put it. Okay, so let's jump in. First up, crypto taxes. For a long time, it really did feel like the Wild West, didn't it? Kind of vague, tracking everything was a nightmare sometimes.
Oh, absolutely. A real headache for lots of people. But yeah, that's changing. Or the rules are becoming clearer anyway. The basic idea from the IRS hasn't actually changed, though. They still see crypto as property.
Right, like stocks or a house.
Exactly. So if you sell it for more than you paid, that profit, usually it's taxed as a capital gain. That part's the same. The big changes now are all about how that gets tracked and, crucially, what gets reported automatically and who does the reporting.
Okay, and here's where it gets really interesting for a lot of folks. The big exchanges, the centralized ones like Coinbase or Kraken, they're soon going to be required by law to report your transaction data straight to the IRS. That's a pretty big shift.
It's a game changer for visibility, absolutely. And it's being phased in, so the timeline matters here. For your transactions happening in 2025, the ones the exchanges will report in early 2026, they'll mainly report your gross proceeds.
Okay, so just the total amount you sold the crypto for.
Exactly. Just the top-line sale number. Simple enough. But then, for transactions in 2026, which get reported early 2027, that's when it steps up. They'll have to report both the gross proceeds and your cost basis.
The cost basis. So what you originally paid for it, that's key for figuring out the actual profit, right?
Precisely. You need that to know if you made money or lost money and how much. Think of it like selling a house. Your agent reports the sale price, and eventually the system knows what you bought it for, too, so the tax folks get the full picture.
Makes sense.
Now that kind of detail is coming to crypto, at least on those big exchanges.
And you get this info, too, right? It's not just going to the IRS behind the scenes.
Correct. You, the customer, will get a copy of this info from the exchange. It'll be on a due tax form, Form 1099-DA.
Okay, Form 1099-DA. So having that form should make things, well, a bit less confusing come tax time for a lot of people.
Hopefully, yeah. More flair.
But it's not all just about more reporting, is it? There's actually some good news, especially for using crypto day to day. Like, remember hearing that even buying, say, a coffee with Bitcoin could technically be a taxable event? I always thought, seriously, for a latte.
Oh, yeah, that was a major barrier.
Yeah.
The idea of tracking tiny gains or losses on every single small purchase, it was just impractical.
Well, apparently that's gone. A new law passed in 2025 brings in a de minimis exemption.
Yes. This is a really significant practical change.
So small, everyday crypto payments, I guess under a certain amount, like maybe $50 or $200, they're now exempt from capital gains tax reporting.
Exactly. It removes that friction. It answers that question. How do we let people actually use this new technology for normal stuff, for daily life, without burying them in paperwork?
Yeah, that makes total sense.
It's kind of like, when you travel and exchange maybe $20 worth of foreign currency, the IRS isn't expecting a detailed report on that tiny transaction.
Right.
This is basically saying, for small crypto spends, let's apply that same logic. Let's not make it ridiculously complicated. It helps adoption, makes it more usable.
Definitely a positive step. And there's another win, right? For people involved in mining or staking.
Yes, another really helpful change. If you're, say, mining new coins, or you're staking your crypto, basically locking it up to help run the network and earning rewards, you used to potentially owe tax when you receive those coins or rewards, even if you didn't sell them.
Right, even if they were just sitting there.
Exactly. But now you won't be taxed on that income until you actually sell or, dispose of those coins.
So the tax is deferred. You only pay when you cash out or trade them away.
Precisely. It shifts from taxing upon receipt to taxing upon disposition. And that's a huge benefit. You're not paying taxes on income. You haven't actually converted to cash yet.
That seems much fairer and probably encourages more participation in those networks, too.
It definitely changes the economics for miners and stakers, likely for the better from their perspective. It aligns it more with how other investment gains are often treated.
Okay, and one more piece on the crypto front.
Okay.
What about DeFi? Decentralized finance. There was some worry there, right?
Oh, yeah, that was a big scare. The IRS initially floated rules that might have treated DeFi protocols, these automated financial systems on blockchains, as brokers.
Which would have meant
Well,
reporting requirements for them.
exactly. Huge reporting burdens on platforms that often don't even have a central company running them. It caused a massive outcry from the industry, from Congress. Even the administration seemed to get involved.
And what happened?
Well, the good news for DeFi users is that regulation got officially withdrawn. Mid-2025, they pulled it back.
Wow, okay.
So it's seen as a huge win for the industry. It confirms, for now at least, that decentralized exchanges, DXs, and activity in your own personal wallet using DeFi. They are not subject to the same automatic reporting as the big centralized guys like Coinbase.
So DeFi stays kind of separate from this new reporting regime.
For now, yes.
Yeah.
What's fascinating here is, well, it showed the government is listening, at least somewhat, to the arguments about how different decentralized systems are. You can't just apply old rules easily. But, experts are quick to warn this probably isn't permanent freedom from oversight. It just means that first attempt was maybe too broad, didn't quite fit. The question now is, what comes next for DeFi regulation?
Right. Always something to watch. Okay, so let's boil this down. With all these changes, the new reporting, the exemption, the staking deferral, the DeFi situation, what's the key takeaway for you, the investor, right now?
Well, first, even though the big exchanges will report their stuff for you, you absolutely still need to track everything else yourself.
Like transactions from your own wallet or peer-to-peer trades.
Exactly. Personal wallets, P2P, any DeFi activity, the IRS still expects you to report gains and losses there. So good record keeping is still essential. Don't slack on that. Second, understand and use these new rules to your advantage legally. That de minimis exemption for small buys, use it. The staking tax deferral. Factor that into your strategy. And don't forget the basics, like loss offsetting. If you have crypto losses, you could often use them to reduce your taxable gains, just like with stocks. That can significantly lower your tax bill.
So stay organized and be proactive about understanding the rules.
Pretty much. It really comes down to, how actively are you managing your own financial information and tax strategy in this evolving landscape.
Okay, super helpful on the crypto side. Let's shift gears now. Let's talk about the stock market and something that impacts, well, pretty much every investor and public company. President Trump is pushing again to get rid of mandatory quarterly earnings reports. He wants companies to report only semi-annually every 6 months. And this time, well, it seems like it might actually happen.
Yeah, this isn't a new idea from him, but the context is different now. And stepping back, this isn't just about timing. It really gets to the heart of, well, how should companies be run? How transparent should our markets be? The core idea is simple. Companies report their financials every 6 months instead of every 3. But the implications? They're potentially huge.
And President Trump's main reason, his argument, is that quarterly reports force companies to be too focused on the short term, right? Like just hitting the next 3-month target.
That's the main thrust, yeah. It's all about combating short-termism. The argument is that this constant pressure to meet quarterly expectations discourages managers from making big, long-term investments in things like research, development, or major projects that might take longer to pay off.
Because they might hurt the numbers in the next quarter or two.
Exactly. So the thinking goes, moving to semi-annual reporting would free up management to focus more on long-term strategy and innovation. There are other arguments, too, like potential time and cost savings for companies, especially smaller ones, from doing less frequent reporting. And aligning the U.S. more with places like Europe and the U.K., where semi-annual is already the norm.
Makes sense.
Think of it maybe like, imagine your favorite local restaurant. If they had to publish their sales figures every single week,
Okay.
they might feel pressured to, use slightly cheaper ingredients this week or maybe delay fixing that leaky faucet just to make the weekly profit number look a bit better. Instead of investing in, say, training their staff better or developing a cool new menu item that takes time but would be great for business down the road.
Yeah, I can see how that short-term pressure could build up. That's a good analogy.
That's the kind of dynamic proponents want to reduce.
And like I said, this isn't just talk this time. What's changed?
Well, the big news is that on September 16th, 2025, just recently, The SEC, the Securities and Exchange Commission, they officially announced they are making a review of this proposal a priority.
Ah, okay, so it's actually on their official to-do list now.
Exactly. It's formally under consideration. And this is very different from 2018 when he first suggested it and it didn't really go anywhere. A huge factor now is the makeup of the SEC itself. There's currently a Republican majority on the board, and the chairman is Paul Atkins, who's known to generally favor deregulation.
So the leadership is more receptive to this kind of change.
That seems to be the assessment, yes. This particular composition makes it much more likely that a rule change like this could actually pass. What's fascinating here is just how much these regulatory appointments can really swing the pendulum on major policies. And importantly, this kind of change can likely be done through SEC rulemaking and probably doesn't need a new law from Congress. Experts think it could happen relatively quickly, maybe within 6 to 12 months, if the SEC decides to move forward.
Wow, okay, so potentially within the next year. So what are the upsides? If this goes through, what are the benefits proponents are highlighting for businesses?
Well, as we touched on, the main claim benefit is that enhanced focus on long-term strategy. Less pressure from the quarterly cycle, more room for innovation and sustainable growth. Then there's the reduced administrative burden. Less paperwork, lower compliance costs, which could be especially helpful for smaller public companies. And finally, that greater alignment with global standards, making the U.S. perhaps more competitive or at least consistent with practices elsewhere, particularly Europe. People like Dina Friedman, the CEO of NASDAQ, have supported more flexibility here.
Okay, so those are the arguments for it, but there have to be downsides, right?
Sure.
Especially thinking about us, the individual investors. What are the big concerns?
Oh, absolutely. There are very strong counter-arguments, and the biggest one really revolves around transparency.
Less information, less often.
Exactly. A loss of transparency and potentially increased information asymmetry. That just means a bigger gap between what different types of investors know. If companies only report detailed financials every 6 months, individual investors like you or me, we have fewer data points, less timely information to base our decisions on.
While the big guys, the institutional investors, might have other ways to get information.
Potentially, yes. They often have more resources for research, maybe more direct access to management sometimes. So it raises a really important question. How do we make sure the everyday investor still has enough information to compete fairly and make smart choices?
Right. That seems critical for trust in the market.
It really does. It's sort of like imagine driving your car, but suddenly half the gauges on your dashboard are only updated every hour instead of constantly.
Okay, yeah. You'd feel a bit blind sometimes.
You'd have less real-time info. It makes it harder to react quickly, maybe harder to see if a problem is developing, and that leads to another concern, potentially increased market volatility. Less frequent official news could mean more uncertainty builds up between reports. And then, when the semi-annual report does finally come out, the market reaction could be much bigger, more jarring, more unpredictable.
Bigger swings in stock prices.
Potentially, yeah. And some prominent experts are really worried about the overall impact. Professor Jill Fish, UPenn, Art Hogan at B. Riley Wealth, they've warned that reducing transparency could actually undermine the trust and efficiency that make U.S. markets so strong globally. They argue the benefits of quarterly reporting, despite the pressures, might actually outweigh these potential drawbacks.
So it really pits that idea of long-term corporate thinking against the need for timely information for investors.
That's the core tension, exactly.
Wow. Okay, we have definitely covered a lot of ground today. We've gone from figuring out how your crypto gains get reported under the new rules, all the way to this major debate about how often big companies should open their books to the public.
And if you connect it all, you see these recurring themes, don't you?
Yeah.
In crypto, it's finding that sweet spot between letting innovation flourish and having enough oversight, making it usable without chaos.
Right.
And with corporate reporting, it's balancing that desire for long-term business strategy against the market's need, especially individual investors' need, for transparency and timely data. It really all boils down to defining what a healthy system looks like.
Yeah, and it just underscores how vital it is for you to stay plugged in to understand these shifts, whether you're deep in the markets or just trying to figure out how this all affects your savings or your investments.
These aren't just abstract policy debates. They can have real impacts.
Definitely. So maybe here's something to chew on for the week. As all this tech and policy keeps changing so fast, how much of the burden should be on you personally to track every little financial detail? And how much should the systems, the exchanges, the brokers handle automatically? Where's the right balance there? And then for the stock market, What truly drives better long-term economic health? Is it that constant drumbeat of quarterly information keeping everyone on their toes? Or is it giving companies more breathing room, a longer leash, potentially fostering bigger, bolder bets?
Hmm.
Which way do you lean on those? Lots to think about. We hope this deep dive gave you some clarity and food for thought. Thanks for joining us.